Welcome to this fast-paced explainer, where we're going to absolutely tear apart one of the most fascinating situations happening in the market right now. We're diving deep into the anatomy of a massive market overreaction to figure out what's really going on with Lululemon. Ticker symbol LULU. I mean, the undisputed king of premium athleisure has just seen its stock completely crater. So the big question we're answering today by looking at the hard data is pretty simple. Is this dramatic crash a structural value trap that you need to run away from? Or are we literally looking at the ultimate contrarian generational buying opportunity?
Okay, let's just get right into the sheer violence of this drop, because it is staggering. Remember, this isn't some highly speculative tech startup. This is a premium retail giant, and it is currently trading at brutal multi-year lows, hitting right around that $118.77 mark. The numbers are honestly hard to process. We're talking about a stock that's down roughly 52 to 53% over just the past year. And if you zoom out, it's down an incredible 65% over the past 5 years from its absolute peak. For a brand that literally defined the entire athleisure movement, Wall Street is currently pricing this company as if it's in a permanent structural decline. People are legitimately out here asking if the whole leggings trend is just completely dead. But to figure out if this massive sell-off is actually justified, we've got to look under the hood.
So what actually went wrong? Well, the root of the panic pinpoints this idea of athleisure fatigue in North America. And it's not just a rumor. There's real hard data backing up a domestic slowdown. Last quarter, Lululemon saw its America's comparable store sales actually drop by 5%. And yeah, that's a significant red flag for a company that was previously priced for hypergrowth. But why did it happen? It really comes down to some surprisingly basic execution errors. A noticeable lack of color variety in their core products literally left loyal customers feeling totally uninspired. And while Lululemon was stumbling over these basics, rising premium rivals like Alo Yoga and Vori have just been aggressively stealing market share. The domestic market got incredibly crowded very fast, and Lululemon definitely lost some of its premium magic at home. Now, the real reason Wall Street completely panicked comes down to profitability. Welcome to the Margin Massacre. Historically, Lululemon has boasted these absolutely incredible operating margins, sitting super comfortably around 18.5%. But stepping into Q1 of 2026, wow, that margin faced a brutal compression, just collapsing down to 11.2%. That is a shocking drop for a premium brand. And you know, when your operating margins drop that aggressively, your net income falls right off the cliff. Combine that severe drop in profitability with management being forced to slash their EPS guidance for the rest of the year, and boom, you've got the perfect recipe for a massive institutional sell-off. Investors suddenly woke up and realized the easy, hyper-growth days in the US market might officially be over. But hold on, because here is where we hit a massive plot twist. If you only look at North America, you're missing half the story. While the domestic market is definitely resetting, the global brand power is scaling relentlessly. Outside of the US and Canada, consumers are still very much in love with Lululemon. Total international revenue didn't just grow, it surged by 22% year over year. And the real standout, Mainland China. Lululemon experienced an explosive 30% year-over-year growth spurt in that region alone. It's genuinely fascinating. We are looking at a classic split personality company right now. Severe headwinds and fatigue at home, but absolutely massive thriving catalysts abroad. Make no mistake, they are still winning on the global stage. To really understand whether this is a dying brand or just a temporary stumble, we have to zoom out a bit and look at the structural track record. From 2020 through 2025, Lululemon wasn't just some passing pandemic fad, it was a highly resilient compounding machine. Total revenue marched steadily upward year after year, more than doubling from roughly $4 billion up to over $10.5 billion. And their bottom line followed suit, with net income compounding beautifully right alongside that top-line growth. This basically proves the company has a deeply entrenched foundation. They know how to scale, and they absolutely know how to make money. The real question is whether this current 2026 hurdle is a permanent roadblock or just a speed bump in a much longer growth story. So the absolutely crucial point here is how this incredible historical growth contrasts with today's valuation. Because the stock has fallen so drastically, Lululemon has experienced a massive valuation compression. It's now completely disconnected from the broader market. Think about this. The S&P 500 average is currently trading at a price-to-earnings ratio of around 26x. Lululemon, it has been compressed down to an insanely cheap single-digit PE multiple of roughly 9.5x. Wall Street is practically pricing this highly profitable athletic brand for bankruptcy. You'd honestly think they were selling rotary phones, not yoga pants. But here is the ultimate defense against the bear thesis: cash. Despite the margin hit,
Lululemon boasts a massive 7.1% free cash flow yield. They are generating an absolute mountain of cash, making this stock look dirt cheap for any investor willing to look past the short-term noise.
Okay, so let's neutrally weigh the ultimate risk and reward debate happening on Wall Street right now. On the bear case side, skeptics are pointing to a structural retail slowdown at home, intensely rising competition from the likes of Alo and Vori, and real fear that the margin compression we just saw is permanent, which would make this a classic retail value trap. But the bull case? Well, they argue a totally different reality. Advocates highlight the hypergrowth global expansion, the massive potential of a simple product reset under leadership to stabilize domestic sales, and the undeniable fact that you're getting massive cash generation at a historically cheap valuation. It's a textbook battle between momentum and value.
Which brings us to the final verdict. Should you buy Lulu at these levels? Ultimately, it comes down to investor psychology and exactly what kind of market participant you are. If you're a momentum trader looking for quick technical setups, the trend is broken, and it's most likely an avoid. But if you're a patient, fundamentals-driven value investor, the math here is incredibly compelling. You're staring at a highly profitable, cash-generating global brand trading at a generational mispricing. Now, I genuinely want to hear from you on this one. Do you think Lululemon has permanently lost its magic, or is this literally the ultimate buy-the-dip opportunity of the year? Drop your verdict in the comments below. And hey, if you found this explainer helpful in breaking down the noise, make sure to like and subscribe for more deep dive analyses. I'll catch you in the next one.